Good afternoon. Today is Monday, the 10th of January, 2011, and as one of my friends was talking to me on chat today, he said resilient, and that's really the best word for this market. It just remains very resilient. It refuses to really sell off. If we take a look at the SPY, it was down 16 cents today, but it finished with a green candle because, of course, it closed higher than where it opened, this being the open right here that I'm pointing to right now, and we ground higher, and in fact, the advanced decline line also just barely tried to squeak positive here at the end of the day, and we actually did finish with 1,548 advancers and 1,400 or so decliners. So more stocks are going up on average than declining. If we take a look at the volume weighted average price since the beginning of the year, that's really kind of been a battle point the last few days, and an area that's taken focus. We once again tested the lows from last week, which were basically the lows for the year as well, and 116.20 is turning into be the important level here. It was prior resistance late last year, turned into support here that's been tested a couple times, and you could make a case, I suppose, that you'd be looking at what people would call a head and shoulders pattern here, although until breaking the neckline at 116.20 it doesn't really make a lot of sense rather to pay too close attention to that. As long as the average price is going up and the stocks that you're in are going up and you're managing risk, that's what remains as always the most important factor. Here we can see the SPY has been really pretty choppy in here, and maybe making lower highs and trying to stabilize here. So short term, I think the S&P 500 is really a little bit more neutral, maybe to flashing some cautionary signs. But this truly is a bigger level, not just because it was late resistance last year and support a couple times this year, but it's also where we have the approximate location of that rising 20-day moving average. So I would take it seriously that if this market broke below and stayed below 126.20, that maybe it would produce a larger sell-off, perhaps down to this trend line or the rising 50-day moving average. I think maybe having a small hedge in this market would be something that makes sense, because we could get a quick and fearful sell-off at any point, although the market's just not giving us the evidence that it's ready to do that at this point. The NASDAQ closed up at new highs once again at 56.08. This market was up 0.38% and finished, as you can see, it touched upon that rising 5-day moving average once again. Year to date, the volume weighted average price, it tested that as well down at 55.60 rather, and that did hold as support. So in the NASDAQ, it's not quite as clear, but I would say the bigger level is still again down near that 54.80, that resistance from late last year, and the location of that rising 50-day moving average. But obviously we're putting some distance between that and building a cushion so that if we're to test that level, I don't think it would necessarily break on the first test. Basically, the Russell 2000 really the more neutral group here, and it did finish with a 0.5% gain today, so it's making up a little bit of ground because this market has been the more neutral one this year. But on a year-to-date volume-weighted average price, we did close back up above that level again today. So we're seeing a lot of just kind of choppy action in the larger ETFs, the market ETFs that is, but a lot of individual stocks still behaving real well. Until the Russell 2000 breaks these lows near about $77.40 or so, you still have to give the benefit of the doubt. You've got stock like Apple at all-time highs, IBM, hit an all-time high the other day. That is on Friday it did. The semiconductors do still hold up. They're more neutral than anything, but really can't look at this thing as even for a short-term trader as a short sale opportunity until it can break below about $32.15 and probably hold below there for a little bit.